United Health Group has been hitting new 52-week lows for the past 14 days straight. But it isn't just the 52-week lows, they are actually trading at the lowest value they have been trading at through the past 4 years. So is the company a value trap, or is now the best time to buy into UNH? Well, first of all, I want to discuss the reason behind them falling so much from their almost all-time high. The reason for that, there are three reasons actually. The first one is that Brian Thompson, the CEO, got shot, which led to widespread criticism of the US healthcare and mainly to increased criticism to UNH. The company also suffered a ransomware attack in 2024, which disrupted electronic payment and medical claims processing and led to lower net income and earnings per share. And the third reason, the final reason, is that UNH missed on both their top and bottom lines in their most recent earnings report and lowered their guidance for 2025. Now, to me, all three of these reasons seem like short-term trends. And indeed, when I scroll down, you can see that according to management, they believe that these factors are highly addressable, and over the course of the next few years, their earnings growth should be back to 13 to 16% year over year. Now, to really figure out if UNH is currently trading in their buying range, we will go through four of our valuation models. First, I will jump to the graphs formula revised, where based on the future earnings per share growth, we will calculate the intrinsic value. As you can see, I have plugged in the 5-year earnings per share growth estimate at 11%. And this is based on the historical earnings per share. If I scroll down, you can see that from 2020, the EPS has grown from $16 to $23.86 in 2023, growing at an average CAGR of 12.32%. And with the management predicting the earnings to grow at 12 to 16% yearly through the next few years, I think that a 5-year earnings growth estimate of 11% is quite right. I will combine this percentage with the average 5-year EPS, the base PE, the growth rate multiplier, and the average and current yields on AAA corporation bonds and get an intrinsic value of $460, which is 21% higher than the current trading price, showing us that UNH might indeed be undervalued compared to their future earnings potential. Now, moving to the second valuation model, the discounted cash flow model, and here we will find the intrinsic value based on the future free cash flow. As you can see, from 2020 to 2024, the free cash flow CAGR is sitting at only 1.72%, but that is because of the large free cash flow drop in 2024 caused by the lower net income. So when I jump to pillar 5, you can see that when we adjust the free cash flow growth, the CAGR will be sitting at about 5.4%. And seeing this, I think it is quite fair that I predict the long-term CAGR at 5% and using that calculate the future free cash flow. Now, to bring the future free cash flow to the present value, I will use a discount rate of 8%, which is about 2% higher than the WACC of the company, accounting for a slight safety margin and for my higher desired rate of return. Now, using this discount rate, I will calculate all the present value of that future free cash flow and then sum it up. And accounting for the total debt of about $81 billion, we will get an intrinsic value of $458.21, again higher than the current trading price. If the company was to have no debt at all, if I was to plug in zero, the intrinsic value will be $547, about 25% higher than what it was before. And the reason for this is because if the company can spend less free cash flow to pay down their debt, they will be able to return more of that free cash flow to investors through either dividends or share buybacks, and therefore they are worth much more. Now, moving to the multiples valuation, we will compare UNH to 3 of its competitors. But before we go through this valuation, I just want to point out 2 things. When I jump back to pillar 1, you can see that from 2020 to 2024, the PE ratio has been growing at a CAGR of about 8.23%. But with UNH's drop in stock price, the PE ratio is currently sitting at only 15.85, much lower than the 5-year and the 10-year average, showing just how cheap the company currently is compared to the earnings they generate. If I jump to pillar 2, you can see that the price to free cash flow has also been growing, but currently it is sitting at only 14.14, again lower than the 5-year average. So you can see just how much undervalued UNH is compared to their historical trading price. Now, moving back to the multiples valuation, I will take the P/E ratios of the company's three competitors and average them out to only 14.36, which when multiplied by UNH's earnings per share of 23.89 will give us an intrinsic value of $343, which is slightly lower than the current trading price, meaning that compared to its competitors, UNH might be slightly overvalued. Nevertheless, we still have one more valuation model to go through, and that is the dividend discount model, where based on the projected dividend CAGR into the future, we will calculate the intrinsic value. Now, as you can see, the 5-year dividend CAGR is sitting quite high at 14%. But this raises the question if it's sustainable. So jumping to pillar 8, you can see that indeed the dividend has grown from $4.83 in 2020 to $8.18 in 2024. Now, if I scroll down, you can see that the free cash flow payout ratio has actually been very stable through the past 4 years, from 2020 to 2023. But in 2024, it shot up to 36.38%. But as we know, the reason for that is the lower free cash flow. And therefore, I do believe that this high CAGR is sustainable. So moving back to the dividend discount model, I will project a slightly lower dividend CAGR just to be safe. This dividend CAGR will sit at 13%, and based on this and the discount rate, we will calculate an intrinsic value of $665.98. Now, moving to the ultimate valuation, I will average out all these four values and get an ultimate intrinsic value of $481.62, which is 27.16% higher than the current trading price. And with a margin of safety of 10%, we would get an acceptable buy price at $433.46, which means that the company is now indeed in our buying range. Now, before ending this analysis, I do want to point out two more things which I really like about UNH. The first thing being that they have been buying their shares outstanding at the rate of about 0.70% yearly, which is quite decent, and their debt levels aren't sitting too high at all. Their long-term liabilities are sitting at 91.98 billion, but they will be able to pay them off in about 4.5 years with the free cash flow they generate. So in my eyes, the company isn't at all in danger from the long-term liabilities they are currently carrying. Now, taking into account the fact that they are trading much cheaper than they have been through the past 5 years, they have growing financials, growing revenue, net income, and free cash flow. This drop is, in my eyes, a real present. So if you wanted to buy UNH ever before, now is the best time to do it. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.